In 1974, a handshake in the desert reshaped the global economy. One side offered protection, the other promised oil, priced only in dollars. From that moment, the world no longer bought energy. It bought access to the dollar itself. For 50 years, this silent pact powered the United States beyond its means. Nations traded goods but settled in paper printed in Washington. Oil became the bloodstream of the world economy and the dollar its pulse. Every barrel sold was a vote of confidence in America's financial order. But what if that order is now cracking? Behind closed doors, central banks are moving gold again. Russia and China trade energy without touching a single dollar. The Gulf is experimenting with digital currencies and bilateral settlements. The pillars that once seemed unshakable, the petrodollar system, the Treasury market, the global reserve structure, are quietly shifting. It isn't collapse that begins this story. It's substitution, slow, precise, hidden under diplomatic smiles. The mechanism that made the US dollar as good as oil is losing credibility for the same reason it once gained it: trust. Trust that the dollar would remain stable, that the US would defend the flow of oil, that inflation would stay contained. But trust, like energy, is finite. Some historians call the petrodollar the second Bretton Woods, a post-gold standard born not in banks, but in oil fields. Its beauty lay in its simplicity. If you wanted oil, you needed dollars. To get dollars, you sold your goods to America. It was not just an economic loop, it was an empire in disguise. Now, that disguise is fading. Nations are asking a forbidden question. Why price oil in dollars at all? The end of the petrodollar won't arrive with explosions or decrees. It will come through contracts, algorithms, and alliances. A quiet revolution written in balance sheets. And when money no longer flows through the same channels, power won't either. If this opened another side of history for you, comment where you're watching from. After World War II, the world needed a new financial order. Gold was still the measure of value, but the dollar became its reference point. The Bretton Woods Agreement of 1944 formalized this hierarchy. Every major currency was pegged to the US dollar, and the dollar itself was pegged to gold at $35 per ounce. The United States held nearly 3/4 of the world's gold reserves, an empire built not on conquest, but on convertibility. For a while, it worked. Trade recovered, Europe rebuilt. The dollar became not just money, but a symbol of stability. When a French businessman received dollars, he knew he could exchange them for gold. That trust, the promise behind the paper, became the backbone of post-war prosperity. But by the 1960s, a quiet imbalance began to grow. America was spending more than it earned. The Vietnam War, social programs, foreign aid, all funded in dollars, created faster than gold reserves could match. The invisible battery of US credibility was draining. Foreign central banks noticed. They started converting their dollars back into gold, shipping bullion out of Fort Knox by the ton. France's Charles de Gaulle sent naval vessels to collect the gold physically, a symbolic act of defiance against the illusion of unlimited credit. By 1971, the math no longer worked. There were more dollars abroad than gold in American vaults. President Richard Nixon faced a choice: lose the gold or lose the dollar's credibility. He chose a third option: to redefine the rules. In August of that year, Nixon suspended the dollar's convertibility into gold, effectively ending the Bretton Woods system. The world entered uncharted territory. Money was now backed by nothing but confidence. Without gold, the dollar risked becoming just another piece of paper. The question was, why would other nations continue to hold it? That is where oil entered the picture. The early 1970s brought another crisis, the OPEC oil embargo. Prices quadrupled. Energy became the new axis of global power. The US, still dependent on imports, faced both inflation and vulnerability. In that moment of danger, Washington saw an opportunity to anchor the dollar again, not in gold, but in oil. In 1974, U.S. officials, led by Treasury Secretary William Simon and Henry Kissinger, struck a quiet agreement with Saudi Arabia. The Saudis would sell oil exclusively in US dollars and invest their surplus revenue in US Treasury bonds. In return, America would provide military protection and political backing. It was elegant, it was silent, and it solved the dollar's existential problem overnight. From then on, if a country needed oil, and every industrial nation did, it needed dollars. Global demand for energy guaranteed global demand for US currency. The Federal Reserve could issue dollars without the constraint of gold because the world itself had to hold them. This was the birth of the petrodollar system, a structure where oil became the collateral of American power. Every tanker leaving the Persian Gulf carried not only crude, but a piece of the monetary order. For the next half-century, that system shaped everything: trade balances, foreign policy, even wars. Nations that challenged it often faced isolation or worse. The dollar was no longer just a currency, it was infrastructure, the plumbing of global finance. But all systems built on trust eventually face a test. The same logic that made the dollar indispensable also made it fragile. When oil is no longer priced in a single currency, when energy flows diversify, the foundation of that trust begins to shake. Every empire has its hidden ledger. The petrodollar's entries are now being rewritten. Every system hides its own breaking point. For the petrodollar, it began the moment the world realized that energy, not paper, held the real value. In the 1980s, the US dollar seemed invincible. Oil prices were high, Treasury bonds were safe, and global trade revolved around American credit. Countries that sold oil reinvested their profits, petrodollars, back into US assets. It was a self-reinforcing loop. Dollars paid for oil, oil profits returned to US debt markets, and debt financed American consumption. The circle was perfect. Until it wasn't. By the late 1990s, the global economy had multiplied several times over, yet the mechanism that made it run, the constant recycling of petrodollars, began to strain. Asia's manufacturing boom demanded more energy, Europe launched the euro, and the US financial system grew addicted to cheap foreign capital. The same flow of dollars that had stabilized the world now fueled speculation. Then came the 2008 financial crisis. When the housing bubble burst, trillions of dollars evaporated from balance sheets. The illusion of infinite credit was shattered. For the first time in decades, central banks began to ask a question that had long been taboo. If the dollar could collapse from within, why should global reserves depend on it? The Gulf states, long pillars of the petrodollar order, quietly reconsidered their loyalties. China, already the largest energy importer, started negotiating direct oil purchases in yuan. Russia followed, creating parallel systems for trade settlement. Even allies of Washington began exploring currency swaps and gold-backed reserves. Some analysts call this de-dollarization, but the word is misleading. It's not rebellion, it's insurance. The world is diversifying its risk, moving from a single financial anchor to a network of alternatives. Still, the structural problem runs deeper than politics. The petrodollar system was built on three assumptions: that the US would remain the dominant consumer of oil, the primary issuer of safe assets, and the undisputed military guarantor of the Middle East. None of those pillars is as solid as before. Shale oil reduced America's dependence on imports, weakening the link between its economy and OPEC's output. Massive deficits and quantitative easing eroded confidence in the dollar's long-term stability. And military interventions that once ensured control of energy routes, from Iraq to Libya, have yielded diminishing returns. Meanwhile, new players entered the stage. China's Belt and Road Initiative extended trade and credit lines across Eurasia. The BRICS bloc, once a loose coalition, began to coordinate on finance and technology. Regional alliances, from ASEAN to the African Union, started experimenting with local currency settlements. Each of these moves chipped away at the dollar's monopoly, but perhaps the most decisive blow came from technology. Digital payment systems, blockchain-based trade platforms, and central bank digital currencies began erasing the need for an intermediary like the U.S. banking network. Energy could now be priced, purchased, and settled directly, peer-to-peer, nation-to-nation. For half a century, the petrodollar functioned as a toll booth on the road of global trade. Every transaction paid its fee in the language of American money. Now those roads are being rerouted. Consider this paradox. The stronger the U.S. sanctions its rivals, the faster they develop systems to avoid the dollar. In trying to preserve dominance, Washington accelerates the creation of its replacement. When the U.S. froze Russia's reserves in 2022, it sent a shockwave through finance ministries worldwide. Suddenly, risk-free U.S. assets looked political. The message was clear: your dollars are safe until they aren't. Gold purchases by central banks surged to their highest level in half a century, not as an act of defiance, but of caution, a quiet exit from dependence. This was the turning point, not a single event, but a cumulative realization. The petrodollar no longer serves as the foundation of trust. It's becoming a symbol of imbalance. And yet, the system still functions, for now. Oil is still priced in dollars, trade data still flows through SWIFT, and the U.S. Treasury market remains the deepest on earth. But beneath the surface, settlement systems are multiplying, currency reserves are diversifying, and bilateral agreements are replacing the old universal standard. The petrodollar is not collapsing, it's dissolving. History shows that empires rarely notice decline as it happens. The Spanish crown still minted silver long after its mines were dry. The British pound remained global decades after the empire's end. The US dollar will follow the same curve: authority without foundation, trust without anchor. What ends the petrodollar is not a single decision, but a million small ones. A Saudi contract in yuan, a Russian payment in rupees, a Chinese refinery settled in dirhams. Each one shifts a fraction of global trust away from a system that once seemed eternal. And the irony is sharp. The dollar, once backed by gold, then by oil, now stands backed only by belief. And belief is the most volatile commodity of all. To understand why the petrodollar is ending, we must first see how it worked, not as a theory, but as a machine. Imagine a circle. Oil flows out of the Middle East, dollars flow in. Those same dollars then return to the United States as investment. That is the core loop. Every actor in this system, producer, consumer, and banker, depended on that continuous motion. When Saudi Arabia sold oil, it received dollars. Those dollars did not stay in Riyadh. They flowed back into New York, London, and Washington, into Treasury bonds, corporate stocks, and U.S. banks. Economists called it petrodollar recycling. It sounded benign, almost elegant. In practice, it created a perpetual demand for American debt. Here's how the mechanism sustained itself. The more oil the world consumed, the more dollars were required for transactions. The U.S. could print or borrow those dollars because foreign nations needed them anyway. The demand for dollars financed the American deficit, and the deficit, in turn, kept the global dollar supply abundant. Debt became an invisible battery powering both sides. But it wasn't just finance, it was architecture. The petrodollar system relied on three main institutions: the U.S. Treasury, which issued the bonds, the Federal Reserve, which managed the flow of dollars, and the U.S. military, which guaranteed that oil would continue to be sold in those dollars. When a country threatened that structure, Iraq in 2000, Libya in 2011, the consequences were not merely diplomatic. Energy independence was treated as a geopolitical crime. Behind the scenes, the system rewarded loyalty. Nations that kept their reserves in dollars enjoyed easier access to global markets, credit, and political support. Those that didn't faced liquidity shortages, downgrades, and sometimes sanctions. The petrodollar wasn't just a currency system. It was a map of power. To see its precision, look at the numbers. By the 1990s, nearly 80% of global oil trade was denominated in dollars. Central banks held over 60% of their reserves in dollar-denominated assets. Every barrel of oil sold required some part of that balance sheet to exist. The more the world grew, the more the dollar's orbit expanded. But systems built on compulsion decay from within. After 2008, interest rates collapsed. The yield on U.S. debt no longer compensated for its risks. For oil producers, the petrodollar loop became less profitable. Instead of buying treasuries, sovereign funds began diversifying into Asian bonds, European equities, and infrastructure projects. The recycling slowed. Then technology struck again. New settlement systems, China's CIPS, India's UPI cross-border interface, the BRICS payment bridge, began to bypass SWIFT. Digital yuan and other state-backed digital currencies made it possible to clear energy trades directly, without touching the U.S. banking network. The architecture that once ensured the dollar's dominance now faces its mirror image, a multipolar ledger where no single currency monopolizes trust. The petrodollar's real genius was psychological. It turned dependence into convenience. It made every oil transaction feel natural in dollars, as if no other option could exist. But convenience, once questioned, becomes weakness. When alternatives appear, the illusion of necessity fades. And now imagine, if tomorrow half of global oil contracts were priced in other currencies, yuan, rupees, dirhams, the entire flow of global reserves would shift. Central banks would rebalance. Demand for U.S. debt would fall. The dollar would still circulate, but its gravity would weaken. That is how empires unwind, not in explosions, but in arithmetic. Each contract, each transaction, each settlement line on a ledger is a small vote. For decades, those votes went one way. Now, they are dividing. The mechanism that once made the dollar indispensable is now teaching the world how to live without it. Every system that expands too far eventually meets the cost of its own success. The petrodollar was no exception. For half a century, it gave the United States what economists call an exorbitant privilege. America could print the currency the world needed, borrow in its own money, and consume more than it produced, all without facing the punishment that ordinary nations face for deficits. Debt became not a weakness, but a tool of dominance. Yet that privilege had a shadow. To maintain the illusion of endless demand for dollars, the U.S. had to keep global energy priced in its currency. This meant constant engagement, political, military, financial, with oil-producing regions. The Middle East became less a market and more a strategic dependency. Every disruption there threatened the very mechanism of the dollar's global role. Wars became currency maintenance operations. From the Iran-Iraq conflict to the First Gulf War, from Libya to Syria, the pattern repeated. Instability justified intervention, and intervention preserved the monetary system. Oil prices spiked, then stabilized, and the dollar remained the reference point. But the cost, in lives, in credibility, in resources, accumulated silently. Domestically, the consequences were subtler but just as deep. Easy credit allowed the U.S. to shift from production to consumption. Manufacturing hollowed out. Financialization replaced industry. Wall Street became the new factory and derivatives the new export. The dollar's dominance subsidized the illusion of prosperity while the real economy drifted offshore. Meanwhile, the global south paid in volatility. When U.S. interest rates rose, capital fled emerging markets, collapsing currencies and erasing decades of growth. When rates fell, cheap money flooded in, fueling speculative bubbles that later burst. Entire regions, Latin America in the 1980s, Asia in the 1990s, became collateral damage in the cycle of dollar liquidity. Energy exporters, too, became trapped. Their national budgets depended on oil priced in a foreign currency they couldn't control. When prices crashed in 1986, 1998, 2014, governments across the Middle East and Africa faced debt crises. To stabilize, they invested even more of their reserves in U.S. assets, reinforcing the very system that constrained them. It was a loop of dependence disguised as stability. But the turning point came not from rebellion, but from exhaustion. By the 2020s, the U.S. debt had surpassed $30 trillion. Inflation returned. The same printing press that once guaranteed liquidity began to undermine confidence. Central banks, which once held dollars out of habit, started asking how much longer the promise could last. Their answer was diversification. Gold buying accelerated, currency swaps multiplied, regional development banks emerged to bypass Western credit institutions, and with every such step, the petrodollar's invisible empire shrank. The irony is that the U.S. succeeded too well. The global system it built became so large that it no longer fit inside a single nation's balance sheet. The petrodollar's dominance required global cooperation, but its benefits concentrated in one capital. The imbalance was mathematical, not moral, and mathematics always settles its debts. Today, as new currencies enter the energy trade, the Chinese yuan, the Indian rupee, even the UAE dirham, the old monopoly fades. Oil, once the guarantee of dollar supremacy, is becoming the catalyst for its dilution. The financial consequences will not appear overnight. They will seep through bond yields, currency reserves, and trade settlements. Bit by bit, the demand for U.S. debt will fall. Interest rates will rise. The invisible subsidy that financed decades of prosperity will evaporate. For nations built on dollar recycling, the transition will feel like gravity reversing. The flows they relied on will slow, the safety nets will thin, and for the first time in living memory, the world will have to price risk without assuming that America absorbs it. Some economists call this deglobalization, but in truth it is rebalancing, a slow return from monetary empire to multipolar exchange. The petrodollar did not fail. It completed its purpose. It bought time for a world rebuilding from war to become interconnected, and in doing so it rendered itself unnecessary. When systems outgrow their creators, endings are not tragic, they're structural. If this helped you see the cost behind stability, tell me where you're watching from. History doesn't repeat, it reorganizes. The logic of the petrodollar still operates, but under new names, new instruments, and digital masks. Then it was oil. Today it's data, credit, and energy in electronic form. The medium changed, the hierarchy did not. After 2008, global finance entered its second artificial life. The Federal Reserve replaced the old oil for dollar loop with something far more synthetic, quantitative easing. Trillions of dollars were created not to buy energy, but to buy time. Liquidity became the new export. And the world accepted it, again. Every central bank followed the same ritual: print, inject, inflate assets. The dollar remained the denominator for trade and reserves because no other system was ready to replace it. The illusion of stability persisted. But illusions erode when the context shifts. In the 2020s, three transformations converged. Energy, technology, and geopolitics began to realign. COVID-19 broke supply chains. Russia's invasion of Ukraine redrew trade routes. And the rise of digital currencies began to erode the monopoly of traditional payment systems. The architecture of the petrodollar, one flow, one clearing system, one reserve currency, could no longer process a world of fragmented realities. Take sanctions, for example. Once a surgical weapon, they became a blunt instrument. When the U.S. and its allies froze Russian reserves, the unspoken foundation of the dollar system cracked. The idea that money is apolitical. Overnight, half the planet realized that their savings could vanish with a signature. The trust that underpinned 50 years of financial order dissolved in a single act of enforcement. China learned that lesson early. Its Belt and Road network functions as both logistics and liquidity infrastructure. The ports, railways, and pipelines are physical, but the real asset lies in settlement systems, payment corridors that bypass the dollar. Through CIPS, China can clear transactions directly in yuan, from energy to electronics. Saudi Arabia, once the cornerstone of the petrodollar, now signs bilateral deals in yuan, rupees, and dirhams. In 2023, Riyadh even hinted at joining BRICS, a symbolic gesture that would have been unthinkable a decade earlier. The signal was clear. The monopoly is no longer sacred. But here lies the paradox. Even as the world diversifies away from the dollar, it still uses the dollar as the measuring stick. Oil may be priced in yuan, but traders still convert its value into dollars for reference. Financial gravity weakens slowly. It doesn't vanish, it drifts. Meanwhile, new currencies emerge not from mints, but from code. Central bank digital currencies, CBDCs, are reshaping the concept of settlement. In China, the e-yuan already circulates in millions of wallets. In India, the digital rupee experiments with cross-border trade. The UAE and Singapore run blockchain corridors that clear oil trades in seconds. These systems are programmable, transparent, borderless. They remove the need for a dollar-based intermediary altogether. Some analysts see this as liberation, others as surveillance. Both are correct. The control once held by the Federal Reserve may soon belong to algorithms coded by central banks across continents. The future reserve asset may not be a currency at all, but a platform. And yet, the emotional core remains the same: trust. The petrodollar survived because the world trusted that the US would keep its word. The post-dollar system will depend on who controls the code, and whether anyone still believes in neutrality. The next reserve standard may not be physical, like gold, or political, like oil. It may be systemic, a network of interoperable ledgers where value flows through consensus rather than dominance. A digital Bretton Woods without a single anchor, governed by liquidity, speed, and code. And in that world, energy still reigns, only now it's measured in kilowatt hours instead of barrels. Nations that master green technology, battery storage, and rare earth supply chains will hold the new equivalent of oil power. So, what replaces the petrodollar? Not a single currency. Not the yuan alone, nor a BRICS coin. What replaces it is a mosaic, a multipolar system of overlapping spheres where trade is settled through regional tokens, bilateral credits, and digital bridges. The empire of one currency gives way to an ecosystem of many. In this sense, history does not break, it bifurcates. The petrodollar era centralized value around a single issuer. The coming era will distribute it among multiple creators. But the law of systems remains. Whoever defines the medium defines the rules. For the first time in modern history, that power is diffusing. It is no longer minted, it is programmed. And now imagine a transaction between two countries, one in Asia, one in Africa, settled instantly, without passing through New York or London. No clearinghouse, no correspondent bank, just code and trust. That moment marks the true end of the petrodollar, not with a crisis, but with a relevance. The system doesn't fall, it fades. The end of the petrodollar is not a collapse, it is a transition. Quiet, mathematical, inevitable. 50 years ago, value was tied to a barrel of oil. Today, it drifts through algorithms, servers, and code. What once depended on pipelines now runs on networks. The symbols changed, but the principle stayed. Whoever controls the medium controls the message of money. Some will call this the end of American dominance. Others will call it evolution. Both are right and both are wrong. The truth is simpler. Every empire builds a system to preserve itself, and that system eventually learns to live without its creator. The petrodollar taught the world to clear, to trade, to think globally. It also taught it dependency. The next era is learning independence, and it is doing so faster than the last could imagine. Gold once anchored trust. Oil replaced it. Now, information will.
The unit of value is no longer a coin or a contract, but a connection, verified, encrypted, and borderless. History doesn't repeat, it waits. It waits for belief to migrate, for confidence to find a new home. And as that migration accelerates, the question is no longer what backs the dollar, but what backs trust itself. The age of the petrodollar ends not with a bang, but with a login.